Are you looking for a way to protect the wealth that you have developed in your family? Are you looking for a way to benefit from inverse correlation, to actually make some gains while the rest of the share market or the stock market is crashing? Well, this is the first charge of my family's trident approach. Here we're looking for safety, we're looking for stability, and we're looking for hedging, that ability to go in the opposite direction of most of the other asset classes. So today I just want to take you through briefly what the purpose of this tranche of the Trident approach is and how we have structured that. Now, first of all, stability. Now, for this, we have some bonds in this approach. Now, as I've explained in other videos, like this one here, bonds are a relatively new part of what we're doing in our family portfolio. Now, as I've explained, we have an interesting little fellow that was born in our family 3 years ago. Now, because he has lots of health and medical and disability challenges ahead of him, we've been looking to increase the stability in the portfolio because we don't know what the future is going to hold. We don't know when we're going to need access to money or how much of the fund we might need to draw on the purposes to help this little guy. Because of these reasons, in 2023, I've been increasing the positioning of the portfolio in terms of adding stability using bonds. Now, as a key part of this, as a key tranche, I've been adding, in particular, some bonds there for some companies that I do like, our Blue Owl Capital, for example, OMF, finance company. So these bonds are really they're the proper corporate bonds. So for most brokers, you buy these in $1,000 lots. Now, I know that makes it quite challenging for many new investors or people, families with smaller portfolios. So there's also another alternative called baby bonds. Now, these trade instead of in $1,000 lots. Baby bonds will tend to trade, or at least the ones that I've been looking at, they tend to trade with a par or face value of about $25. So it's much more accessible to buy a single bond. And because they trade on the stock exchanges, much like a stock, you might even be able to access these using fractional shares. Now, a couple of big differences between the main bonds, the corporate bonds, and these baby bonds. Now, the corporate bonds that I've been looking for have been investment grade. I've been looking for those specifically with higher coupon rates or higher distribution and income opportunities there. So sort of 7-8%. I've also been looking for those with a very short duration. So those that are expiring in the next, I think, 3 or 4 years were part of my criteria because I don't want that money locked up for too long and I don't want to have the risk of that money in the corporate bond for too long. Now, is that important? Well, yes. Some bonds, for example, will be looking at an expiry in, say, 2062, for example. Now, that is mind-blowingly a long way into the future. I'd love to still be alive at that point. And so I'm not looking for that. I'm looking for very short term. I'm looking for high yield, and I'm looking for investment grade for safety. Now, some of the reasons for those companies, now, as you remember, with bonds, these are going to be paid back. If the company cannot pay the bond back, that company is basically gone burgers. Now, what that means is they've got a high degree of getting that money back. Now, with a company like Blue Owl Capital, because of the way in which they're structured, there is a limit on how much debt they're allowed to use. And that means that that debt is very limited. It's a relatively safe, a relatively secure, and a relatively stable company and bond issuance because of that. The debt limits mean that they're very, very likely to be able to pay back that debt in the case of something going horribly wrong. And things do be horribly wrong from time to time. That's okay. With the baby bonds, I'm looking for something a little bit different. With the baby bonds, I'm often looking for a higher, what we call yield to maturity. Now, with the baby bonds, my experience, what I'm looking for are baby bonds which have fluctuated more in price, whereas the corporate bonds will tend to be fairly stable around that $1,000 face value. I'm often looking for baby bonds which have come down in price a little bit. So instead of trading at bang on the $25 that they'll be redeemed at, the company will pay me back when that baby bond reaches that maturity date. I'm looking for a bond that instead of $25 might be trading at, say, $22. Now, that does not sound like a huge amount. I agree. But what it means is I buy it now at $22 and the company will pay me back $25 at the maturity date. So yield to maturity is taking not only the income that the company pays me in the meantime, but it's also taking into account that capital appreciation over, say, often a 2 or 3 year or 4 year period that I'm looking for with the baby bond. So I'm looking for that appreciation to that par value plus the income as that yield to maturity. Now, there you're taking on perhaps a little bit more risk, but again, think about that capital stack. I am looking for these bonds as they're going to be repaid. I'm looking for companies that I'm confident will have the cash flow, that will have the cash, that will have the assets to repay bondholders before, except for example, common stockholders are wiped out. So I'm looking for yields to maturity there, which are more high. Now, couple these together. So I've got stability, I've got my more stable corporate bonds, I've got my baby bonds, which are more volatile, but which also, because of that, is going to give me a slightly better and a slightly improved yield to maturity and a high yield and higher investment return as a consequence. Now, another important way of framing this tranche of the Trident approach is part of this is almost a pseudo emergency fund. If you have a margin account, you can buy these bonds and you can actually borrow against them. Now, because their prices are much more stable, and even those baby bonds, those prices, even though they fluctuate more than the main corporate bonds, those prices are still going to be relatively stable. Now, what this means is if I can borrow against the value of these bonds, that means I can essentially put my money to work in the market in this relatively stable investment. And then if I need to, instead of selling, I can actually borrow against these using the margin facilities at the broker. So in this way, it's not the same as an emergency fund. And I certainly advocate, and we still have an emergency fund that's actual cash, but it does mean that there's more access to some funds if and when required. Now, that's all stability. What about hedging? So I've talked a little bit about this. Now, the hedging component is simple. If the stock market goes down, I want to have holdings that are going to increase in value. Now, the big benefit of this is if the stock market comes down in price and my alternative assets are going up in value, at some point I can sell those assets that are at high levels of value. I can capture that capital gain and then I can use that money to buy the main tranches of the stock market investing, say an index like the S&P 500 or other ETFs that have decreased in value. So I capture gains from the assets going up in value, I reinvest those in the assets which have gone down in value, and then as they begin to normalize, I have made additional gains. So I gain on the alternative investments, and then in the future, I'm hoping to gain again on the value of those stock or ETF holdings as they gain value again in the future. Now, there's a range of different ways of playing this. I like managed future funds. So KMLM is the primary fund that we hold. It's a relatively new fund, but it does follow a very well-established index that's been going for, I think, about 30 years. The benefit of this index is it shows over time a low level of correlation with stock indices and with major stock market indices like the S&P 500. And that, to me, is very powerful. Now, of course, there is another issue there called tracking error, where the actual investment product doesn't quite match up with the index performance. I'm putting that aside for the time being. The key thing here for me is that inverse correlation. Stocks go down, this fund will go up. Generally, it's not a perfect level of correlation, but it's not bad. Now, in the past as well, KMLM has also paid dividends. I was expecting to get a nice little dividend payment in December. Unfortunately, the fund did not pay out a dividend last year, so that was a bit disappointing. But again, income there is not my primary purpose. My primary purpose is hedging. Now, I am looking to add a few other funds later this year as well, other funds in that futures area. Now, as well as this, there's also a couple of really interesting stocks as well that I will hold in this basket. Again, I'm holding them primarily for that hedging characteristic. Now, the first of these funds is listed on the American exchanges, VIRT. Now, this is essentially an exchange, a company that benefits from high levels of transactions. So the more transactions, the bigger the flurry, the bigger the panic in the market, the more income this company earns. Now, think about that. As stocks begin to plummet, if there's a disaster, if there's a stock market crash, there's a flurry of activity. Lots of people buying, many people selling. And that massive surge in transactions for VIRT is income, it's earnings. And as that happens, then the value of this company, the share price increases along with that higher, greater level of earnings. And so again, serves as a hedge in the market. Now, it's not the only company of this type. There are other companies, one in Europe that I know about, I think it's called Flow Traders, FLOW. I think it's based in the Netherlands and Amsterdam. And so if you're in Europe, that may be a more appropriate option for you. Now, in both cases, they're relatively large companies, but they're also companies that we haven't necessarily heard of before. And so it's a little bit under the radar. Now, one of the beautiful things about VIRT as well is it pays a dividend. So again, music to my ears. So I'm getting paid to wait, and then if stocks go down, the value of this holding will go up, and then I can use that benefit, as I explained earlier. And in the meantime, I collect a dividend. Now, it's not a dividend growth machine. I believe it's held the same dividend constant for many years now. That's not a big issue. From memory at the moment, it's something 4 or 5% yield, I think. Investable in my mind at the moment. I believe the company is still a little bit undervalued. So that's what my family's doing in this first tranche. We've got some bonds for stability, corporate bonds. We've got some baby bonds, which give both higher income and yield to maturity, as well as stability. And then we also have the hedging basket, the managed futures, as well as these other stock holdings benefit and gain in value as the stock market value begins to drop if there's a disaster or a stock market crash. So let me know in the comments down below, does this approach resonate with you? Do you do anything similar? And if not, why not? What do you think could be done better in this part of our investment approach? Let me know. I'm always keen to hear your ideas and learn about some fabulous new or different ETFs or other funds that I may not know about.